I'd like to walk through a problem where I show you how to do the gross profit margin and the inventory turnover. Again, the gross profit margin measures your markup on your goods, and it's your gross profit off your income statement divided by your sales. Sometimes they'll call it gross margin or even gross profit margin. Now, as far as how you calculate it, you're going to, we're going to use this example down here. You're going to take your gross profit, which actually would normally be told on here. I just wanted to make sure you could figure it out. And what I would do is take my sales minus my cost of goods sold, and then you divide it by your sales. You take that then and multiply it by 100% to get a 40% markup. Now, you'll be asked in your assessments to identify different types of companies, and in general manufacturers tend to have a higher markup. So if you were looking at, say, a Walmart, it has a very low markup or a very low gross profit margin compared to, say, a manufacturer of industrial equipment or to an exclusive jewelry store. So anyways, that's how you do the gross profit margin. The other is the inventory turnover, and you take your cost of goods sold off your income statement and you divide it by your inventory. Now, actually, a lot of times you take average inventory, but for this course we're going to keep it simple. So you get that amount, and that represents the number of times your inventory was basically at that level and then completely sold off and repurchased to that level again and sold off. In other words, a number of times per year you've had that inventory balance. So that turnover can be translated in terms of number of days that it takes on average to sell your inventory. And what you're going to do is take the number of days in a year and divide it by your inventory turnover that you calculate here. So let's go through an example using this down here. We have the inventory turnover. Again, you take your cost of goods sold off your income statement, and then you go to your balance sheet and get your inventory. And that comes out to 6 times per year. So in other words, this company had inventory of 1,000, sold it all off, bought another 1,000, sold it all off, another 1,000, sold it all off 6 times, in other words, during the year. So another way to look at that is, okay, so how many days does the inventory on average sit on the shelves? You take your number of days in a year and divide it by your inventory turnover, and you'll get 61 days, and I've rounded up. So on average, this company takes about 61 days to turn its inventory over. Again, you'll be asked to use these ratios to identify different types of companies. Companies that have a high turnover, again, would be like a Walmart or a Dollar General. A company that would have a low inventory turnover would probably be the more exclusive jewelry stores or furniture stores, even automobile or sellers of automobiles.